If you're confused about where gold and silver are headed next, this video will clear everything up. I'm going to show you the charts, the critical numbers, and give you exact price forecasts that could make or break your investment decisions. Plus, I'll reveal why 14 major groups just got suspended in China and what this means for your metals. Don't skip any part of this video because the forecast at the end might shock you. Welcome to Con Invests. Today's update is packed with important information. We're going to look at the technical charts for gold, silver, platinum, and copper. Then I'll break down the latest economic data. And finally, I'll show you both long-term and short-term price forecasts that will help you make smart decisions. If you're new here, hit that subscribe button and the notification bell. If this video helps you, smash that like button. It really supports the channel. Let's start with gold. Right now, gold is down about 1%, but here's what's really important. Gold came down and tested the 50-day moving average, but it stayed above it. This is a very strong sign. For those who don't know, the 50-day moving average is just the average price over the last 50 trading days. When a price stays above this level during a pullback, it shows strength. Gold is also bouncing off the 20-day moving average right now, and that's very positive. In fact, over the last month, gold is actually up 13%. So even though we had that huge drop when silver hit around $120, gold has recovered nicely. From where I'm standing, gold is in a better position than silver right now. It's holding its key support levels, and this makes me confident that gold is still in a strong uptrend. If you're stacking metals, gold should be your priority right now. Now let's talk about silver, and this is where things get a bit more concerning. Silver is in what I call a danger zone right now. You can see silver is clearly below its 20-day moving average. It came down, tested the 50-day moving average, and is now printing just above it. The 50-day moving average for silver is at $77.50, and we're currently at $80. So we're only $3 above this critical level. This is something we need to watch very closely. If silver breaks below the 50-day moving average and stays there, it could signal more downside ahead. Performance-wise, silver is down for the week, but up 16% for the month. So on a longer time frame, silver is still doing well. But on the short-term charts, we're clearly below the 20-day moving average and testing the 50-day. We need to see silver print above the 50-day moving average consistently, and preferably get back above the 20-day moving average. Keep a very close eye on this going forward. Let me quickly touch on platinum and copper because they're giving us important signals too. Platinum has a different story. Not only did it break below the 20-day moving average, but it's actually printing below the 50-day moving average now. This represents a danger zone to me. If I'm an investor right now looking at precious metals, my order of preference would be gold first, silver second, and platinum third. Copper shows a similar pattern to silver. It's broken below its 20-day moving average and is testing the 50-day. But the good news is it's printing above the 50-day and actually looks close to reclaiming the 20-day moving average. This is positive for copper as an industrial metal, which often signals economic activity. Now let's talk about the gold to silver ratio, because we're seeing a fairly dramatic change here. The ratio tested the 20-day moving average and went above it. Then it tested the 50-day moving average and went above that too. The gold to silver ratio is now at 62. Remember, this got down into the mid-40s not long ago. This big jump shows that gold is actually in a stronger position relative to silver right now. This is a change from what we saw last week, so pay close attention to this going forward. The gold to silver ratio is a very important indicator for us as metal investors. The other big change we're seeing is with the US dollar. Many people, including myself, have been talking about how the dollar is weakening. It kept resisting and holding strong, but guess what? The pressure has finally broken through. The dollar is now breaking to the downside, and this is very positive for our metals. As you can see on the charts, we're below the 20-day moving average, below the 50-day moving average, and now below the 200-day moving average. The dollar is sitting at 96.87. Remember, not long ago it was up around 110. It's come down significantly, and we know our president wants it to come down further. This is marching in order with what they want, and it's very beneficial for us as metal investors. Let's talk about oil because this is important for the bigger economic picture. Oil has now broken out above its key moving averages. It's above the 20-day, above the 50-day, and now above the 200-day moving average. I think this is very good as a hedge against some of our metal positions, but also as a hedge against the economy. I see oil going higher from here. It could go dramatically higher from where it sits right now because historically, oil is very low at current prices. Let's shift to bonds because we're seeing a big change here too. We saw interest rates creeping up, which means bond values were falling, but that has changed recently. We're starting to see some breaks in yields. We're now below the 200-day moving average on yields below the 20-day and testing the 50-day. These yields are strengthening, which means people are rotating back into bonds. For all the talk about the dollar being weak, the world is still putting money into U.S. Treasuries. These yields don't come down unless investments are flowing in. It would be interesting to find out where exactly these investments are coming from. But we have to be honest. These bonds are actually strengthening right now. If we look at Japan's bonds, we see a similar pattern. These bonds are testing the 20-day moving average and could break down to test the 50-day and maybe eventually the 200-day. This bond strength is actually counterproductive for our metals. We want yields to go higher for metals to rally, but right now, they are where they are. Let me show you some key economic indicators that are important right now. GDP growth is sitting at 2.3%. Interest rates are at 3.75%. Official inflation is at 2.7%, but I don't believe this number at all. Unemployment is a very important number we need to watch. Our trade deficit continues. Debt to GDP is extremely elevated at 124.3%. This is a very important week for economic data. Today we have non-farm payroll data coming out. But what I'm really focused on is Wednesday when we get the unemployment rate, currently projected at 4.4%. We have to pay attention to this because if we see unemployment spiking, it will change everything. We know big companies like UPS, Google, and Amazon have laid off tens of thousands of people. I believe this is going to drive up unemployment. When you combine this with what's happening in the AI space, we're starting to see real displacement in the economy. How will the Federal Reserve react? I believe it's going to give them a green light to drop interest rates as we move forward. Also, on Friday, we have all the inflation data coming in. That will be very important for us to watch. So this is a huge week for economic news. Stay focused. Looking at M2 money supply, no surprise here, it continues to go up. We're getting very close to numbers we've never seen before. Now, if we look at what the Fed is likely to do with rates, things have changed. Previously, there was 100% probability we wouldn't change rates. Now, that's dropped to 80%. I think this is a result of the economic numbers we're starting to see. But if we go out a little further to June, there's a strong belief we're not only going to cut rates by a quarter point, 50% probability, but another 25% of analysts think we may even cut by half a point. These interest rate movements are extremely important for our metals. The trend is our friend, and it very much looks like it's coming our way. Let's talk about the Consumer Price Index and inflation. I've told you before that I don't believe inflation is going down, and I definitely don't believe it's at 2.7%. If you look at the charts, inflation continues to increase. I don't believe that's changing, and I doubt many of you do either. Your real-world experience at the grocery store, gas station, and everywhere else tells you the truth. Now let's talk about what's happening at the CME, Chicago Mercantile Exchange, because this is very revealing. Last week, the Silver Volatility Index was sitting over 100, and I said that's a very cautionary level. It's now down to 90. That's still very high, but it's definitely improving. When I show you what's happening with margin rates, you're going to be shocked. Gold's volatility was sitting around 32-33, and it's now down to around 28. These numbers are important because the CME uses them to decide margin rates for trading gold and silver. Here's the shocking part. Gold margin requirements are now up to $46,000. That's very high. It broke through 40, then 42, and now it's at 46. But the real shocker is silver. Look at this, we're up to almost $76,000 per contract. This is a dramatic increase from where we were. The CME is absolutely putting the screws on, trying to restrict silver's movement. In the past, these restrictions haven't really worked long term. But what they're doing is taking out the tourist investors, the high-frequency traders, and the highly leveraged speculators. For us as owners of physical metals, this is actually good. It allows a strong foundation to build for future growth. The weak hands are being shaken out. Our national debt continues to increase. We're getting close to 39 trillion in debt now. We've added almost $500 billion in debt in just the last 3 months. Whatever they're doing to slow the deficit growth, it's still a runaway train. This is super positive for our metals because how do you solve this problem? You can either default or print money. And what will they do? They're going to print money. The leverage ratios in paper markets are still very high. 378 to 1 for silver and 140 to 1 for gold. Our deficit with China continues to go down slightly. But the reality is our debt is out of control and no one is willing to do anything about it. Looking at top asset performance, silver has reclaimed the number 2 spot, but only by a tiny fraction. It's fighting with Nvidia for that position, and both are down a bit today. But gold is the absolute monster. It is the defining asset of our world, the only tier 1 asset on this list along with the dollar. Gold's performance this year has been incredible. Now let's get into the forecasts because I know this is what everyone really wants to see. I want to emphasize something important. Stay long-term focused. Don't be a flipper. Be someone who buys metals for the right reasons and holds them long-term for financial protection and proper allocation. Looking at the long-term forecast for gold, we've been long since 2023. Even though we had drawdowns, we continue to be long. This hasn't changed. Now, if I look at the short-term forecast on a 4-hour basis, you can see how confusing trading can be. You get sell signals, then buy signals, then sell, then buy. We're sitting in a sell signal right now with gold down 1%. These short-term signals can literally drive you crazy. As someone who understands markets well, I can tell you this is where investors really struggle. Please stay long-term focused on the fundamentals. For silver, we've been long since 2024. This hasn't changed even with all the volatility. Even though we tested from way up in the 120s all the way down to the 60s, the long-term signal has stayed bullish. We're still long on silver. Right now, we're down about 3.25% today. And we're still in a state of backwardation, meaning futures prices are lower than spot prices. I think there's some congestion in the market. There's still a struggle to find physical silver in the world. People want it now. By the way, we're seeing this in real demand. People are ordering silver and they want immediate delivery. Now the short-term forecast gets even crazier. Sell, buy, sell, buy, sell, buy. Just complete randomization. I promise you it will drive you crazy if you focus on this too closely. Stay away from short-term trading and focus on long-term holdings where you can feel secure. Let me wrap this up with some final thoughts. We have to stay on top of these market changes because things are moving in real time. Pay close attention to the jobs report coming this week and especially the inflation data on Friday. Those are going to be very important for determining where markets go next. Remember, as stackers and long-term investors, our job is to stay focused on the fundamentals. The debt is out of control. Money printing continues. Central banks are buying gold. The dollar is weakening. These trends favor precious metals over the long term. Don't let short-term price movements shake you out of your positions. Build a strong foundation, dollar cost average into your positions, and think long-term. If you found this analysis helpful, please hit that like button, subscribe if you haven't already, leave me a comment below with your thoughts or questions, and share this with anyone who needs to understand what's really happening in the metals market. Thank you so much for watching. Stay informed, stay disciplined, and keep stacking smart. I'll see you in the next video.